You're about to hear my conversation with Corey Martin, Chief Executive Officer and Portfolio Manager of Barrow Hanley Global Investors. Are you building a portfolio for the next 10 years? Learn why you need global equity exposure and why those markets are ripe for alpha capture. You'll also hear the case for value investing right now and specifically about the benefits of a traditional value approach. Finally, Mackenzie has recently launched a global value equity mandate in partnership with Barrow Hanley, so learn about the history of Barrow Hanley as well as the investment philosophy of the firm. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction. Today, I'm joined by Corey Martin, Chief Executive Officer and Portfolio Manager of Barrow Hanley Global Investors. Corey, thank you for joining the podcast today.
Well, thank you. Thank you for having me.
Corey, I'm going to get right into our conversation. Barrow Hanley has deep roots in value investing. My background, portfolio construction, I have to be honest with you, can't help but notice renewed enthusiasm for value strategies right now. Do you feel conditions support value in a way that will persist for years to come?
We really do. And this started to normalize back in 2021. We think there are really a few drivers as to why value investors are really considering value at this point again. And we have seen a significant uptick in interest. And, first, I think it's finally sinking in just how concentrated the market has been and the very wide, just large dispersion in valuations between, value stocks and your typical, high growth area within the market. And we're currently at all-time historical extremes. And so it really looks a lot to me and to our team like it did during COVID. And, we saw it happen in 2022. And over those periods, when you get a collapse in market multiples, it strongly benefits value managers. So, there's a margin of safety in there that protects you on these multiple contractions. We just saw that, a couple of months ago again, although it's corrected now. Another reason I think there's renewed interest here is probably because if you look at the average growth manager over the last 5 years, something like 90% of them have underperformed and failed to outpace the MSCI World Index, relative to value managers over the last 5 years, where about 55% of value managers have outpaced the MSCI World Index, with the median manager really lagging by only 50 basis points. So it's been much more difficult for growth managers to keep up, given the concentrated nature of the market, as opposed to value managers, which have a very broad opportunity set.
That's very good, Corey, and a great way to open our conversation. But I just realized some of our listeners might not be as familiar with Barrow Hanley as I am. Maybe take a minute or two, give us an overview of the firm, and if you could, maybe share a bit of the history and what defines the organization.
Yeah, so the firm is 48 years old. I've been at the firm for 28 years. Originally, the guys came from the Northeast. They were working, a couple of them in Philadelphia. And people don't know that Philadelphia was really the breeding ground of early value in the 50s and 60s at Girard Bank. The team started Barrow Hanley Moynihan and Strauss, and they came down to really run Republic Bank's trust department, which at the time was one of the largest trust banks in the U.S. That was in mid 70s, and during that time we had some changes in the structure legally called ERISA, and it allowed people to come out of trust banks to start managing money. So the firm was founded in 1979. It started as U.S. large cap value. Over the past 28 years, we have branched out into underlying, very strong regional mandate, regional teams, U.S. large and mid, non-U.S. developed markets, and emerging markets. And the client base now is based all over the world. And so we have clients, about 16 billion of the 60 odd billion that we have under management are clients based outside the US. We've got 21 different strategies, 12 equity strategies, high yield bank loans, and investment grade fixed income. So it's a boutique firm, highly diversified by asset class and also clients literally on every continent. So that's the history of the firm, always been value.
Very good. Great introduction. I like that you mentioned continents because you didn't know this, but Here's where I'm going with this. I want to talk to you about a new, relatively new global equity mandate. Mackenzie has recently launched a global equity value mandate in partnership with Barrow Hanley. If you are a portfolio manager, I would love for you to talk to us about the bottom up value approach in this global equity mandate, given there's going to be regional considerations. This is not limited to one geography. So please tell me more.
Well, we believe this is one of the strengths of our global value strategy. And you should consider this a go anywhere, best ideas strategy. We can invest in any region of the world, sector, industry, group. And in fact, you're really looking to own the very best stocks. And it doesn't matter to me and our team where they are, US, Japan, China, Australia, Canada, emerging markets. We're literally just trying to find the best risk adjusted, upside relative downside that we can find. And our ability to do this is very efficient because I mentioned the regional teams that cover US, non US, and emerging markets. They are the framework of, or call it the research platform that we utilize to build our 50 to 70 stock portfolio. So, whenever we're considering a new addition to the portfolio, we're looking at each of the stocks owned in these regions and based on our assessment of asymmetry of risk and reward on those holdings. And we can determine which one offers really the best risk adjusted return on a global basis. I should also note that when you look at the portfolio, our regional weights, sector, industry exposures are really a pure function of where we're finding value from the bottom up. And we do not have or to apply any sort of top down macro opinion on the portfolio. We do build in macro scenarios when we're thinking about our bull, bear, and base case estimates on what we think could happen to the stock if we're right. If there's a problem, how bad could it get? But we're doing that one stock at a time. And so that's how we kind of work through a very wide universe and opportunity set.
Excellent. Now, I don't mean to be flippant with this comment, Corey, but when it comes to global equity investing, there's a lot of stocks out there. Like there are a lot of securities, and there's an enormous amount of information. So what would be helpful for me, and I think helpful for our audience, a little bit more into the process. What filters do you and the team use? What signals help you quickly narrow down opportunities that fit the value discipline? I'm really trying to understand really what helps you differentiate between noise and signal as an investor.
You're right to say that. There are literally thousands and thousands of stocks out there within the universe that we could look at. And obviously, the hardest part of being an investment manager is time management. And so we've developed very quick ways to sort of narrow down the global universe using some very but robust sort of screening tools. And there are two important points to note before we talk about this idea generation. The first is that however you're sourcing your ideas, you need to make sure that the tools that you're using align with your investment philosophy. Are you using the same fundamental screens that you adhere to? But you also need to make sure that the tools you're using align with capital market theory. And so we believe strongly in our philosophy of value. Plus, we want change, we want a catalyst. And so, how do we do this? So I mentioned the screening, I mentioned the underlying supporting strategies that we use. So we use these screens, but really 95% of what we do comes after the screens. And so the way to think about that is the screens will highlight sort of dislocations around the world within industry groups that we can very quickly determine are cheap and there's been a dislocation. And we do that, think of almost like a heat map. So if it shows up as green on the heat map and it's a Japanese chemical company, we're going to look into that because it's going to mean it's got a low price to book, a low PE multiple. The EV metrics are very low, and it's got a dividend yield, at or above the market. In most cases, on the screens, the companies are value traps. They deserve to be down there. So how do we work through that and trying to determine if they're a value trap or not? Well, the first thing we do is, hey, this is a cheap company. Is it a good business? And if it's not a good business, that's a deep value name. We're really not into those, turnaround stories. So we want cheapness with change. And within our screening process, we're looking for stabilization of operating fundamentals on things like our margins troughing and inflecting up, our sales seem to be troughing, earnings troughing and inflecting higher. So if you can get cheapness with stabilized operating fundamentals, it reduces the probability you're going to get caught in a value trap. And so we're running these screens for the global strategy, also for all the underlying strategies that I mentioned earlier. So it's a very efficient way to manage a very large opportunity set. And then once the screens identify dislocations, those are sent out to the analyst, and the analysts spend sometimes months researching a name, hopefully not months, but to try to determine, hey, is this something that is worth considering including into the portfolio?
Corey, those were really insightful comments. And if you don't mind, I'm going to ask you a couple of follow up questions based upon what you just shared. I was struck by the fact you said 95% of the work occurs after the screen is completed. And for me, you're alluding to skill, and Barrow Hanley has been doing this for decades. I also loved the example of this Japanese chemical company that you were sharing. We're talking about the global equity mandate. So, skill in global equities. Maybe remind our listeners. Often investors are thinking about like which markets are efficient, and often there's more alpha to be achieved by skilled managers in markets outside of, say, the United States. So, at a high level, why are global markets often more attractive for an active manager to apply their skill and deliver alpha for their unit holders?
That's actually a very good question because it is much less efficient, and it starts at the benchmark. The position sizes are much smaller. For example, unlike the S&P concentrated, large stocks, there are 10 large stocks in the MSCI world. They're the Mag 7 plus, a couple of other ones, but information flows, particularly in emerging markets, are not nearly as good as in the US. And so even when you think about that, even Europe, parts of Asia, much less efficient than US large caps, for example. You also have the ability to really meet with management, and they're a little more open. They don't have Reg FD requirements like you have in the US. So they tend to tell you more about really what they're thinking. It's not insider information or anything like that, but you can really dig in with these names. We also love to go down the market cap spectrum. And as you do that out of large cap, which are the most efficient, mostly, covered on the sell side and buy side, down the market cap spectrum, you get into mid caps, you get into much even more inefficient markets. And so with a global mandate being as broad as it is, you really have much more opportunity to sort of exploit these inefficiencies and dislocations.
That's excellent and really helpful. Thank you. And the second follow up is just to dig in a little bit more into something that you said in your prior answer. You made reference to deep value stories. You said the team is not really into that. You don't really get involved in turnaround stories. That I think again is speaking to the investment approach and the investment philosophy for many of our listeners. Again, just still trying to get familiar with the approach at Barrow Hanley. Why? Why would you not get involved with those types of opportunities?
Well, I think when you think about our style, we would call that traditional value. And what does traditional value mean? It means we really want to buy good companies that are down for reasons we can identify and believe to be temporary. What we mean by good is companies that have had historically higher than market rates of return on equity, earnings per share growth rates, a better reinvestment rate. Reinvestment rates are important because you reinvest in the business, which really grows the future earnings stream. So that's very different. And those periodically will stumble. Even names like Microsoft, we own for 10 years, world class, great company. What we tend to avoid is high leverage where there's a lot of risk. And so if you think about deep value investing, it's typically in this most cyclical parts of the market. I love those names. If we can find one where the risk reward is not binomial, in other words, we could make 400%, but if we're wrong, the stock could go down, 70 or 80%. And so we're careful when we do go down. We will buy deep value, but we're really going to be on this entire spectrum from deep value to more defensive compounders. And we're going to play on both ends of that spectrum at all times. And in most cases, when you think about a deep value manager, it's a great way to invest over the long term, but it can provide a very volatile calendar year return pattern, sort of a boom bust cycle. And, for retail investors, especially, our strategy provides a more stable sort of calendar year return pattern that tends to not get out on these ends of the spectrum that can be incredibly volatile.
That's so insightful. Thank you, Corey. My next question actually touches on another comment that you made earlier when you were referring to the investment process. Again, I can't help but notice that you tried to share with us how you guard against value traps. Is it fair to say the difference between a genuinely mispriced security of a great business and a structural value trap would be the identification of catalysts that would come to fruition?
It does. So, I've talked about we like cheapness, we like good companies, we like stabilization of operating fundamentals. But in this 95% of our work where we're meeting with management, we love multiple ways to win. And so I've already mentioned some. You can get a re rating of multiples, you can get inflection on earnings, but there can also be businesses that are for free within the company. I mean, I think John Deere had a very good tech component, precision ag that wasn't even priced. It was a whole nother business. And so, that was a catalyst for John Deere years ago when we owned the stock. So we like all of those things together. And if you combine catalyst with cheapness and inflection and earnings power and determining if it's a good business and it's not in secular decline, that gives you multiple ways to win as opposed to just hoping you get a mean reversion, which is what used to happen, 30, 40 years ago in value.
Very good. Thank you very much for helping us better understand the approach. Now, Corey, I'm just looking at the time. I only have time for one more question. So, as we wrap up, could you share what you believe is Barrow Hanley's enduring edge in delivering alpha in the value strategies, specifically the strategy that we're talking about today?
Yeah, it's something that I'm personally very proud of. I mentioned that the firm is 48 years old. When I joined, and Mark Giambrone, who manages your mid cap U.S. mid cap value strategy, that was 28 years ago. We were the third generation of investors. And when you think about a boutique transitioning the 5 Ps, I'll call it, and I know this sounds old school, but I believe it's the key to success is if you get the Ps right, which are people, philosophy, process, portfolio construction, and you can get the first 4 Ps right, you will deliver ultimately strong performance. And we're now hiring our fifth generation of investors. And so some of us have seen multiple cycles. We know what levers you can pull in different industries that are going to work. We know it doesn't work. We've been meeting with management our whole careers. And so maintaining that philosophy process through multiple generations, and we're now on our fifth generation, as I mentioned, that is key. And it's hard to find at a boutique. A lot of times boutiques, don't invest for the future. The founders go away and the strategy and philosophy is kind of non-transferable and the firms end up failing. And so I think we've done a good job. In fact, we've been written up in the U.S. Pension and Investors as one of the best succession planning firms in the industry. And so really adhering to all of these things have given us 45 years now of generating strong asymmetry in our performance patterns and almost all of our strategies. I think 9 out of 10 of our equity strategies are ahead of their benchmarks over a 5-year period. That's pretty hard to do. So that's really our key advantage is stability of the people, stability of the process, the ability that we've transferred that intergenerationally. That's something we're very proud of here at the firm.
And so you should be. Corey, thank you very much. I really enjoyed our conversation and really appreciate you taking the time to join the podcast today.
Thank you so much for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.